Welcome to The Explainer. Today, we're going to demystify a core financial strategy, hedging. Think of it like this. It's basically insurance for your profits. And in a world that's, well, pretty volatile, it's an absolutely crucial tool for keeping things stable.
All right, so here's our game plan. We're going to start with the big idea. What even is hedging? Then we'll get into the actual toolkit, the different derivatives you can use. From there, we'll look at some real-world examples, and we'll finish up with a practical framework you can actually put to work.
Okay, so first things first. Before we get into the how, let's talk about the why. What's the fundamental problem that hedging is trying to solve? I mean, why do we even need this stuff? Let's try to make this super real. Imagine this. Your company is owed €1,000,000. Awesome, right? You've already booked that revenue, but here's the catch. Until that money actually lands in your bank account, its value in, say, US dollars is totally up in the air. It's a moving target. And that's a classic textbook risk in international business. And it's the perfect setup for why you need a protective strategy. And that's where hedging comes in. It's the answer. Honestly, the absolute best way to think about it is just like insurance. You're paying a small, known cost, a premium, to shield yourself from a huge, unpredictable loss. You're basically trading a little bit of certainty right now to dodge a potential catastrophe down the road. But, and this is super important to get, you have to understand the trade-off. Hedging is not a free lunch. No way. You are deliberately giving up some potential gains. So, in our example, what if the euro had suddenly skyrocketed? Well, your hedge might have capped how much you made on that. See, the goal here isn't to get the maximum possible profit. The goal is to create stability, to make your cash flows predictable. Okay, so let's get into the nitty-gritty. Let's look at the actual tools a financial manager has in their toolbox to build this protection. We're going to break down the 4 primary types of derivatives that get used for hedging. First up, we've got the most straightforward tool in the kit, the forward contract. This is probably the most direct way to tackle that euro problem we just talked about. So what a forward does is let a company just completely eliminate uncertainty for one specific deal. Our company that's waiting on that €1,000,000, they can use a forward to lock in an exchange rate today for that payment they're going to get in, say, 6 months. Boom. No more guessing, no more sleepless nights worrying about what the currency markets are going to do. All right, next on the list, futures. Now, they sound a lot like forwards, right? And they do a similar job, but there are some really critical differences here. And if you're a financial manager, you absolutely need to know them. The 2 magic words you need to remember here are standardized and exchange traded. See, unlike those private, custom-made forward contracts, futures are bought and sold on an open exchange, kind of like stocks. And that fact alone, that standardization, it changes the entire risk profile of the deal. So let's break that down. Here's the core difference. A forward is private, it's customized. That's great when you need something very specific. The downside? Counterparty risk. The other side of the deal could just default. A future, on the other hand, is standardized and traded on an exchange. That means there's a clearinghouse guaranteeing the trade, which basically eliminates that counterparty risk. So the choice is clear. You're trading customization for security. Okay, on to our third tool, options. Now, this is where things get really interesting. Hedging strategy starts to get a lot more flexible, a lot more nuanced. We're moving beyond just locking in a single price. And honestly, options are a total game changer. It all comes down to one critical phrase. You have the right, but not the obligation. Think about that. You pay a little fee called a premium, and in return, you get the power of choice. You're not locked in like you are with a forward or a future. If the market suddenly moves your way, you can just let the option expire and grab that better price. That's a kind of flexibility you just can't get anywhere else. And that right there is why options are so incredibly powerful for hedging. It's like you get the insurance policy against a disaster, but you don't have to give up your lottery ticket for a big win. If the market goes against you, you're protected. If it goes for you, you just walk away from the option and take the profit. You kind of get the best of both worlds. And the cost for that amazing flexibility, that's the premium you paid up front. All right, last but not least in our toolkit, swaps. Now, if you think of forwards, futures, and options as tools for specific transactions, think of swaps as the tool for managing big, long-term structural risks, the kind of stuff that lives on a company's balance sheet for years. You know, a classic example is a company that has a big, long-term loan with a variable interest rate. That's a nightmare for budgeting, right? Your costs could go up at any time.
Well, with an interest rate swap, they can find another party and agree to exchange their variable payments for a fixed payment stream. Just like that, they've locked in their interest costs for years. That's how you create real long-term stability.
Okay, so we've got our four main tools: forwards, futures, options, and swaps. We know what they are. So the next logical question is, how do big companies actually use this stuff to solve real everyday business problems? This is where the rubber really meets the road. An airline is terrified of fuel prices spiking. They use futures or options to lock in a price. A tech company selling tons of stuff in Europe, they use forwards to hedge all that euro revenue. A manufacturer with that pesky variable rate debt we talked about, they use an interest rate swap to fix their costs. You see, for every major risk, there's a specific tool for the job. All right, this brings us to maybe the most practical part of this whole explainer. We've got the theory, we've got the tools, but how does a financial manager sitting at their desk actually decide what to do?
Well, the very first step is just matching the tool to your specific risk. It's almost like a simple decision tree. Do you have a known fixed amount of cash coming in at a specific future date? Okay, use a forward or a future. Is your exposure kind of uncertain, or do you really want to keep that potential for a big upside gain? That screams option. And if you're dealing with a long-term structural problem on the balance sheet, well, that's what swaps were made for. And this right here, this is your ultimate takeaway. It's a professional 5-step process that you can follow. Step 1, you've got to identify and quantify your risks. Know what you're up against. Step 2, figure out your objective. Are you trying to smooth out every little bump or just prevent a total wipeout? Then you select the right tool, decide on the size of your hedge, and finally, and this is key, you constantly monitor and measure how well it's working. That is the complete framework for doing this like a pro. So let's just end with this thought. At its core, hedging is all about managing a trade-off. Yes, it gives you that crucial stability. It protects your profits from disaster, but there is always a cost, and that cost is the opportunity for a bigger gain that you might be giving up. So the real skill for any financial manager isn't just knowing the mechanics of how to hedge. It's developing the wisdom and the judgment to know when to do it, and, just as importantly, by how much.